Hello and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World Headquarters in Bloomington, Minnesota. Revenue Rocket is the world's premier growth strategy and M&A advisor for tech-enabled services companies. With me today are my partners, Matt Lockhart and Brian Burnett. Welcome, guys.
Well, good to have you, Mike. We've missed you for a couple of weeks here, but always better to have you at the helm, my friend. It is a great subject today. It's a great day here in we're based in Minnesota, and when that sun starts shining, we get a little flustered and tough to communicate, I guess. But it's a great day. We got a great subject. Ryan, what's happening?
Hey guys, thanks again for tuning in. Today is a great, another one is in the books for us. And so we have been working on Project Neptune. This was a sell-side deal for Revenue Rocket, meaning that we represented the seller in a transaction and that deal closed. So today we just want to walk through the process of what it takes to take an MSP to market. And if you're considering a sell-side deal, what that process looks like. And so Mike, Matt, you both worked with our client for quite some time. What can you describe just the firm in general and just what made them an interesting sell-side client for Revenue Rocket? Mike, why don't you get started?
Yeah, sure thing. This was a company that is an infrastructure managed services company, I would say on the West Coast. They are very well run, very profitable, and do what most infrastructure managed services companies do. I think if there was any focus here, there certainly was the founder of the business had a deep expertise in sort of data center and developing data centers, building data centers. There was some work that was done there for kind of larger enterprises that require data centers, but had morphed the business in recent years to more what I would consider traditional SMB infrastructure managed services, and did a great job.
Yeah, to probably a little bit of detail on that. The company had pretty some good growth. So going into the year, about 30% growth, and then over the years that growth rate was good. Good solid EBITDA margins. So on the higher end, we're talking a firm that had almost 30+% adjusted EBITDA margin. So well-performing firm. So I think part of the discussion and decision here was I've built a healthy business. It's got my recurring revenues up, and the growth and profit are all there. Matt, what's the signal there? When you hear those numbers, and you're looking to represent a company, how do those numbers sound to you in comparison to other people that might be listening today that might want to take their firm to market?
Well, I mean, just strong performance. And I think that, one of the key things that, we always evaluate is there a track record of that performance? And, with Project Neptune in particular, they did have a strong track record of consistent growth and consistent profitability. And so, obviously they were in the upper tiers from just a metrics perspective with their profitability. And then the other thing of note for anybody who's thinking and considering is, and we say this all the time, they had their ship in order with regards to their financials. I mean, they did a good job for a smaller MSP in managing the financials, in being consistent with their accounting and having that, come through. So, obviously you want to be able to demonstrate that there's a track record. You want to be in those upper tiers, if not in the upper quartile against your peers. Be able to show that forecast moving forward, that there's good stability within the business, and then have that come through on paper in the financials themselves.
Yeah, the owners of Project Neptune, it seemed like they built a business to a stage in which they did have a great, strong EBITDA, but they were also not necessarily interested in scaling the business further themselves. So, Mike, when we talk to owners like we do in Project Neptune, can you just explain it? What are some early signals that they saw that they thought, maybe it's time to take a look at how combining with another firm could help the firm as well as just help their financial situation and help everything else regarding the company and the transaction.
Yeah, I think, they came to the realization, I think the leadership and ownership came to the realization that, growing one of these businesses is tough. They had been pretty darn successful in growing it themselves, but there'd been some ups and downs along the way, as there is in every small business and, MSP in general. There's, as you're sort of transitioning the business or focusing the business on more efficiency and effectiveness, particularly as it relates to recurring revenue, there's some ups and downs. There's certainly some staff turnover and a few things that created some ups and downs in the business. And I think, the current leadership felt that they had grown the business to a point where they needed to be part of something bigger to continue to scale and grow the business. They needed other roles in the business that, they wanted to essentially be part of a larger enterprise that could provide more infrastructure around them to help them continue their growth journey. When the leadership of this company was, what we often use term selling in, right? They weren't selling out or leaving or running for the door or whatever. They were saying, hey, I'm going to stay on. I'm going to be part of the new entity. They did roll equity into the new entity, meaning they took some of their equity and swapped it for the bigger company's equity to be part of that and be an owner in that new entity as well. So they believe in the mission, the combined mission. And I think all those things coalesced in sort of their thinking about, hey, we really need to be part of something bigger, and, then decided to take action on that by coming to us to help them run that process.
Yeah, thanks, Mike. And when we started out with this team, it was a husband and wife team, or is a husband and wife team, pardon me. And the husband was CEO. I kind of come from an enterprise application background, enterprise security background. And his wife had a great background in finance and was doing a lot of the books. But I also believe the wife, in this case, was ready to step away from the business as it tends to soak up a lot of energy to be part of the business and a bit of stress. Matt, I wonder if you'd be able to expound a little bit about what other stresses do you see, or signals do you start to see from founders when they say, okay, this might be the time. In this case, if they're growing the business, the stress there from within the owner just running it. What other things do you start to see, or did we see here with Project Neptune?
Yeah, I think that sort of one of the most common things that we see is that, businesses have pretty natural inflection points when they're growing. And there's sort of levels, right? And both levels of responsibility from the founders themselves, as well as, sort of continued need for reinvestment, putting more money in the business to enable it to grow, as well as, continuing to sign up and, for leading and growing a bigger organization, personally from those founders. And, oftentimes what we see is, people, get in with a, certain mindset in terms of their, sort of work-life balance. And oftentimes when they hit, one of these inflection points and they say, well, is it time to reinvest? Is it time to reinvest personally? Is it time to, take that next mountaintop, right? And that's oftentimes a 3 to 5 and could be even longer, time period in which you're thinking about that next level of growth and what it takes to get there. And so, oftentimes at that time they say, well, no, now is a good time. We built it to a point that there's real solid value. There are opportunities to continue forward with the business, but in a new light, with a new chapter. And so, let's take that opportunity to explore. And I think that was the case in the situation, but it's we do see it on a fairly regular basis where it's like, look, I don't need to change completely, but I can de-risk a bit, as well as sort of create a new chapter where it's not, quote, all on me. and I think that was the scenario that played out really well with Project Neptune.
Yeah, I think exactly right. And when they came to that conclusion, I think they came to it together as well. And uh, there's a lot of work that actually went into researching. So the owners in this case actually talked to a wide range of people, so from advisors to investment bankers to people in peer groups in their space. Mike, can you tell me a little bit more about the decision-making process that an owner is going through? Like what kind of questions they are asking, and a specific in Project Neptune's case, what were they asking out of an advisor in this process? What were they looking for?
Well, in this case, as you mentioned, Ryan, I mean, they went through a pretty exhaustive search of advisors. Fortunately, we were able to be the one that was selected to help them. But, they want to know, what experience do you have in the space, right? Where have your recent successes been? They want to talk to references, right? They want to know that you have represented companies to the market and successfully transacted deals that have helped them, meet or exceed their financial, strategic, and cultural goals pursuant to the deal. You need to know that you have the reach and expertise to run a real process, right? And that's evidenced by the metrics in a deal, right? I mean, we have, I think, really interesting metrics on this deal, and you want to be able to know, like, what are the metrics of a deal? Meaning, how many people did you do outreach to? How many sort of NDAs did you sign? And how many indications of interest were submitted? And ultimately, how many LOIs did you get in pursuant to getting this done? And, did that give them choices? They want to know, as a seller, that you're going to give them choices, right? It's critically important, I think, to be able to run an efficient process with choices that create competition. And so if you're a business owner and you're contemplating hiring, a broker slash, boutique investment bank like Revenue Rocket to bring you to market, you need to have confidence that you're going to have a high certainty to close, that you're going to run an efficient process that's timely, and that you're going to be able to have someone who has the expertise throughout the entire life cycle of things that are needed to help you. And that includes things beyond just being able to do outreach and open dialogue. It has to do, do you have the financial resources inside of an advisory firm that can effectively value that firm, that have credibility and expertise, but also can, defend your diligence as you work through a buyer's inquiry or quality of earnings in some cases. It's critically important that the advisor has, strong financial chops to be able to help. Because it's one thing to make an introduction. It's another thing to, do all of these things with the volume and expertise that's needed to really run a credible process. And I think any seller that's looking to interview an advisor needs to be asking the hard questions about that in order to have confidence that they can get a deal done, they can give them choices, and they can represent them through the full life cycle of the process. And certainly in this case, this seller did that with us.
And I'd like to say, our last podcast that we recorded was really the difference between taking a call from a suitor versus going to market. And we represent buyers in the space all the time that are great buyers. In this particular case, someone had actually reached out to the Project Neptune owners, and they looked to inquire more. And I think that was that first signal that they realized, hey, maybe there's something more there. And just digging in a bit. So it took the time to actually go and research advisors, take a step back, talk to people. I think it was a really smart move on their behalf. Maybe took a little bit longer because you're talking to more firms, but the end result from that initial discussion, they got nowhere close to where they would have started compared to where the transaction ended up. So at the end of the day, it was a healthy process for the seller, even though they were approached by a buyer in the first place. And that's the case oftentimes where if you feel like you need to have more representation and get in front of more people, this is a great way to do that. Speaking of the process here, after Project Neptune, they decided Revenue Rocket was it. What we did on our process was the first thing is really intake. So we're spending time to really understand and understand the firm, the vision of what they'd like to do. Really understand if the company's going to be quote unquote selling in or out, as Mike discussed earlier. We talked a lot about the structure and ideal people. We also talked a lot about ideal buyers that were in the marketplace. So the first step it was just really packaging. That packaging step, we're taking a deep dive into the financials. We're really trying to understand how the firm looks, reacts, everything in how we can best bring them to market in the best way. So digging into those financials, balance sheets, P&L forecasts, we're kind of leading that process to bring things through. Once we get firms to a process to a certain point, Revenue Rocket then starts to market you to the world. And so in this case, we've created a 1-page or 2-page teaser that really is really like, for example, on Project Neptune, we've had marketing materials from landing pages on a website all the way through different marketplace listings to teasers, and just getting people in. And also within our process, we start to reach out to likely buyers. In this case, it was a big process. And so when we started out, we had about 180 firms that were in our list that we were talking to. In this case, we signed about 60 NDAs. And of that, we typically shared that confidential information memorandum. From that, we actually put through a number. We got about 12 different indications of interest. And just telling you this is a firm that was well represented, but also tell some dynamics in the space that when a great asset comes to the market, that sale can have a lot of business to it. At the end of it, we had one great outcome in that we found the right buyer and we went through that process. As we went through that process, and this is something, Matt, you've seen quite a bit here, when we moved, those IOIs were before an introduction meeting, if I remember that correctly. And so that may not always be the case, but Matt, what experience have you seen when you start to kind of work with the information that's provided in that process kind of before meeting the team? And how does that help the team that's going through the process, the sellers, remain focused on their business?
Yeah. And that's what transpired. That was one of the things that our client gave us feedback on was he felt as though it was, using his words, an easier process than he expected, because he felt like if he could provide the information, then he had a lot of trust that we were going to be able to represent him well and make his life easier so that he could continue to stay focused on his business. And that's just what happened. And, you spoke to a lot of it in the packaging. Obviously, it was also in helping to maintain and keep the financial picture clear and transparent and easy to consume. But it was also in the work that we did with the prospective buyers, the big list down to that IOI list in really clearly communicating the values of the firm as well as the desire of the sellers. And, some of the cultural aspects that were going to be important in lining up. So being able to convey sort of that full picture with the data, but then also the stories to be able to really line up those that are most applicable to having that strategic, cultural, and financial fit come together, which then culminated in those 12 IOIs. So you can't just be, throwing information out. You really do need to guide. You need to speak in the voice of your seller. You're really a member of the seller's team. So getting to understand their personality and as well as obviously understanding the strategic components of the deal, which is what we do all the time, I think make it easier for the seller to be able to continue to run their business without, sort of that extra undue pressure of selling the business.
Yeah, I think that was one of the benefits here. We were able to keep the team on track, even though the ownership team was going through this. And so being just a voice of clarity, voice of reason helped us to really get through this. And when you think about this, Mike, the seller here had pretty lofty expectations when he came into the process. And he had one of the things that we recommend that you have, which is he had a number in mind. And his number was actually really, really, really aggressive based on his size. So his number was about 12 times EBITDA. And we didn't quite land there. But Mike, how did we help bridge that value expectation gap? And what should sellers start to think about? We are of course always trying to get the best outcome for our clients, and that includes a willing buyer and a willing seller. So how should an MSP set their expectations of what the reality of the market is, and how did you do the best work to help get the best deal that we possibly could?
Well, good question, Ryan. I think what's important is you need to have sort of a credible, unbiased valuation done of your business. The value in the marketplace ultimately comes down to what someone is willing to pay, right? There's a lot of spreadsheet math and things that go into creating valuation, but ultimately when push comes to shove, it's what someone's willing to pay. And as I said for years until I actually visited a Turkish bazaar, I don't say that anymore because he was far more sophisticated than my uneducated mind could contemplate when I actually did it. But, I used to say that this is not a Turkish bazaar in the sense that you can just name your price and someone's going to pay it. It doesn't, or have an expectation of value that doesn't align with the business performance. And so I think having a credible understanding of what the actual value is of the business will level set your mind as a seller to determine, whether you should contemplate a deal now or whether you should grow your business more before you would contemplate a deal. And I think certainly to get and maximize value, you need to, well, it'd be my opinion, you need to work with a credible advisor to not only help you position and market the firm, but create the competition to come to a optimized deal structure. So to answer your question more directly, Ryan, a big part of what we do with the client in the sell side, or even when we're representing buyers in many cases with firms, is help them understand what fair value is in their business. Help them get a perspective on what the marketplace is likely to pay. Because remember, we got to come back to willing buyer and willing seller, willing to transact a deal with the price and terms accordingly. And so a wish is not a plan there. So you need to be able to align around real work that's meaningful, that's tested with current comps, ones that are reflective of real private to private transactions that occur in the marketplace, that are indicative of what the market will pay, and then be able to, provide that education and backup and discussion in this case with our client around that, and then be able to formulate a plan to, optimize the value we could get within the bounds of what is fair. And to not confuse, simply a multiple of EBITDA as valuation. A lot of folks throw around multiples of EBITDA. We certainly do that as well. But that's just for comparison purposes or for sort of a thumbnail sketch. It is not a real valuation. So you need to do a comprehensive real world valuation to probably shape your thinking around what someone is more likely to pay in your business, and then create competition to optimize value so that you can, begin to find a fit that will work. And, as Ryan mentioned earlier, there's certainly plenty of great buyers that, and we do outreach to companies all the time that we think would be a good fit. But we come at that with a very surgical approach, and do it in a way that, we think we can get to fair value all the way around, and ultimately create a conversation that is win-win. I think in the end, these deals have to be win-win. They have to be based in sort of the current market reality. And, typically no unfair deal gets done, in my opinion. That's how we, get to the finish line.
Yeah, that's well said, Mike. And I'd love to hear some specifics of the deal. We don't have to get super specific in that. And Mike or Matt, I'm not sure who's best at answering this, so I'll leave it out here. Can you just tell me about deal structure? When we finally got those IOIs or indications of interest to the table, and we went through a round of letters of intent, what was this kind of structure that these offers were seeing? Kind of what should sellers expect when it comes down to that actual offer structure?
Well, I'll weigh in on this. I think, certainly there's components of a deal. You can imagine it could be all from 100% cash to, 100% what we call variable gain share, earnout, whatever you might want to call that. Most deals, though, are composed of a portion that's cash at close, a portion that may be equity exchange or equity roll, a portion that's earnout, that's based on some thresholds being met, or customers being retained, or whatever it might be. And sometimes there's what we call a seller note, where the seller finances part of the purchase. We saw offers all across the board in I don't know, I guess 12 or so indications of interest we received on this deal. And, we worked with those suitors to optimize it to what was more preferable based on this particular seller. And, everyone has a different appetite for risk, and for, oftentimes you'll hear the term, hey, we're going to take chips off the table. That has to do with typically cash at close. And there have different levels of appetite for gain share to optimize value through an earnout. When push comes to shove, offers are not evaluated simply on their enterprise value. The structure is incredibly important in thinking about whether an offer you make as a buyer will be accepted, or an offer that's made to you as a seller should be accepted. And I think you need to think about the impact of each one of those portions of that variable compensation. But I would say that almost every offer had a portion that was cash, had a portion that was what we'll call earnout. Some had seller notes, some didn't. Some had equity roll offers, and some didn't. It just depended on the buyer. In this case, we aligned to an offer that was predominantly, I'd say, cash, with some equity roll and an earnout. And ultimately, it led to, I think, a very favorable enterprise value, one that our particular client, in this case, the seller, was very happy with.
Yeah, I think that you're exactly right. That it was a big cash portion, and at the end of the day, that's what their seller was looking for, and that's a part of the deal here. Is if you have to work with someone that can allow you to get to the structure you want, not just enterprise value. As we went through this process, and Matt, I just only have a few more questions here. Um, you know, we got some great feedback from the seller. He mentioned we negotiated beyond anyone's expectations and knew the space better than anyone. And it really it was very happy to hear that when he mentioned it. I'd love to understand, that's the rosy part. Were there some bumps in this process that you would advise sellers that they might go through, that they should just prepare for?
Um, yeah, in this particular case, there were some delays. And so the process took a little longer than expected. And this wasn't a bad thing, the delay itself. It was just the seller needed to do some work on their part. They changed some financing plans. They had some control situations that they needed to straighten out, all for good, reasons and good business sense and the like. But it resulted in some delay in the process. And so, look, it's to everyone's goal to run a smooth and efficient process. Mike, maybe one of the more applicable things that you've taught us and said is that, sometimes doing a merger or an acquisition can be one of the more unnatural acts of business, right? And sometimes things just can't go perfectly smoothly. It's still the right deal. It's still a good deal. People aren't doing anything to cause delays in this case maliciously. They were not at all. But that's why you have an advisor on your side as well, is we do see things, and sometimes we do see delays that really should cause concern, in which you have to ask the hard questions as to not only the viability of the deal, but the trustworthiness of who you're looking to partner up with. And so we see it all the time in this particular case, rightful reasons, and it's actually good for the new company altogether, and it'll be good for our client. Some of the reasons that cause some delay, but I think maybe that is one of the things, is that we none of us have a crystal ball. We wish we did, but there are sometimes things that just come up. You have to make sure that you are working with your advisor to understand and justify the need, right, for any bumps. Things will come up, could cause delays, could not, but the unexpected will happen, and just be open and understanding, and again, work closely with your advisor.
And Mike, or Matt, just a point, just a tiny point of clarification. The buyer actually was going through some of those structural changes, and that's some
That
of the
is,
things we
yeah,
see. And so coming together in that merger oftentimes takes a bit. Sometimes buyers need to figure their own things out, and where the highest enterprise value and the best strategic fit might be to someone who's still going through that. And so sometimes that can cause some delays. I think one of the things that Mike, Matt, you both did just brilliantly, and a huge support and shout out to our financial team as well, was keeping the sellers really focused on running their business. And we fielded a ton of questions. So any kind of question or response, we tried to just minimize the amount that the seller had to work through, so they could really focus on running their business, like it's not for sale. I think it was an important part here. Matt, or pardon me, Mike, for us, I think this is a fun deal for us. It was a great deal for the seller. The buyer is happy, and I think we found something where there's a willing buyer and a willing seller, and the market really came together. There was great strategic fit. There was a good cultural fit, and eventually that led to the financial fit that came together. If you were going to give some advice to someone who's going through the same journey that the owners of Project Neptune went through, and what advice would you give them to kind of every sell side deal that we work with in taking this next step?
Well, I think being able to trust to find an advisor you can trust, and one that has a deep enough bench of expertise throughout their staff to really provide the input you're going to need. You need experts in research and outreach and finance and deal making and marketing to be able to do a deal credibly. There's a lot of advisors that talk about how they can bring you to market. And, but they may not have the depth of the bench that's required to do it in a meaningful way. And I think that's an important consideration. I think firms that they're focused exclusively on our niche also have a level of expertise and relationships, more importantly, of buyers that you can't find with a generalist. And so, there's certainly a lot of people out there that say they can bring you to market credibly and be a great advisor, right? And there are, frankly, there's quality firms out there. But I think as you're looking to work with one, you really want to be able to not only test their capability by looking at their team, but also to test their results, their longevity, their reputation in the market, their success rate, right? And you want to talk to others they've helped. Because I think being able to be selective, as this particular client was, when they fortunately selected us as their advisor, and contemplative of, kind of looking at in some ways, not only the capability of that advisor, but the personality of that advisor and how they do their business, and make sure that aligns with your expectations, will certainly be super important and will help you have a high level of satisfaction with the transaction. It's not, in some ways, just about getting a deal done. It's about getting the best deal done. And it's about the journey and being able to go through that journey in a way that's not disruptive to your business, because that can have catastrophic negative results for you as you're focused more on the deal than running your business, and ultimately lose value in your company during a process. You don't want that. So you need to, I think when our client said to us it was a lot easier than he thought it was going to be, that's very much music to our ears, because that's frankly the way it should be, right? You're bringing on a partner that does this for a living, and you should be able to, for the most part, outsource that function to them. So you can continue to do what you do, which is grow your business, evangelize your business, and continue to make sure that it delivers well for your clients so that you can maintain the value ultimately for the transaction. And I would encourage everybody to do some shopping around. You have choices. You have firms that will do this on a contingency. You have firms that do it like we do, with a retainer and a success fee. And I like to think our results are much more effective than those that do it on a contingency, because we've made the investment to build a team, just as others have in our space as well. But you want to make sure that your interests are aligned and that you've talked to a variety of firms to make sure that works.
Yeah, I think that's a great wrap up. Matt, any closing thoughts?
No. Well, I guess I'll close as we did the other day with our client. Congrats to Project Neptune and their buyer. I think we learned they will be releasing a press release, so we'll look for that. But congrats, and we look forward to seeing the fruits of their labor and seeing that business grow. So it was a good one. Mike?
Yep. With that, we'll tie a ribbon on it for this week's Shoot the Moon podcast. Encourage everybody to tune in next week when we continue to unpack the topics of the day as it relates to M&A and strategy, growth strategy optimization in our space in the world of tech-enabled services. With that, I'll wish everybody a great week. Take care and look forward to you tuning in next time.